Hi, this is Roger Conrad. I'm editor of Utility Forecaster. What I want to talk about today is really the relative value of bonds and stocks. A lot of investors I've been talking to recently have talked about how they're very nervous about the stock market. They think we may be heading for a double-dip recession, rather. They're worried about some of the things going on in Washington. They're worried about the possibility of inflation, problems for the U.S. dollar. And as a result, they've pulled some of their money out of the stock market. Unfortunately, where some of them seem to be thinking there's a safe haven is in the bond world. Those of you who read Utility Forecaster and look at the portfolios or follow the conservative holdings in particular of the income portfolio know that I'm a frequent recommender of bonds. In fact, I believe that the utility bonds issued by regulated utilities, particularly those with maturities of 5 years or less, are some of the absolute safest things that you can own as a long-term investment. We recommended a whole basket of these back in January of 2009, and we saw at that point some pretty tremendous yields there. Yields to maturity, which basically take into account the erosion of a bond's value to principal or an appreciation if it happens to be trading below par, but basically a pretty good measure of what the actual returns on these bonds are going to be annually. Some of these yields to maturity, 8-9% at that time, for very, very strong companies, because that's pretty much all we recommend. Now those same yields to maturity are much, much lower. And in fact, one very instructive example is to take a look at Southern Company. An A-rated company, rated A by S&P, also very highly by other services, for good reason, because it's a core electric utility serving the Southeast, which is one of the most economically stable areas, regulatorily stable areas of the country, have taken some knocks in the housing market the past several years, but still, again, one of those places in the country where you see foreign investment coming into. You see, businesses and everybody, people thinking about growth. So Southern's been a beneficiary of that all along, and investors know that. It's been one of the highest premium utilities out there. Well, if you look back about a year ago, investors were demanding 5-6 percentage points more to buy a Southern Company bond than they were to buy U.S. Treasuries. And that was pretty extraordinary. That was an extraordinary time to buy bonds. But now you see those same bonds, 10-year bonds, yielding maybe 30 basis points more than the equivalent U.S. Treasuries. You've gone from something like 500, 600 basis points to 32 basis points. Basically nothing at this point is what investors are requiring to buy Southern Company bonds versus equivalent U.S. Treasury bonds. And that's pretty extraordinary. You don't see that very often. And it extends all the way down the credit chain. You've got Enterprise, which of course is one of our favorite MLPs out there, especially now that they completed the takeover of TEPCO Partners and have become the largest MLP. They've had tremendous opportunities to grow with acquisitions, very easy time raising capital, which of course is a very strong key to success. But they're rated BBB minus. They're one of the highest rated MLPs, but again, BBB minus, investment grade. Very, very low investment grade. Looking around the time last year, again, the same time Southern Company bonds were trading 600 basis point premium. Enterprise even higher, 800, 900, 8, 9%, 10%, some of these bonds were yielding. Now you look at them, the spread is back about 140 basis points. So a pretty dramatic drop, again, in the required risk premium. Now, what does that mean for you, the investor? Well, if you're an equity investor, it's great news, because it means that the companies you own are borrowing at lower rates than ever. That means they can recapitalize their balance sheets. That's what we've seen across the board, extending maturities, cutting interest payments, and so forth, which immediately adds to earnings, putting the building blocks in place for growth, as we've seen with acquisitions, also with capital spending and so forth. It's great news. Couldn't be better news. And that means higher profits. It means greater ability to pay dividends and actually increase those dividends, and that's the driver of share prices going forward. So very, very, very bullish. In fact, it's probably the most bullish straw in the wind out there, if you will, for the economy, but also for recommended companies. But as far as bond buyers go, if you're buying bonds, if you own bonds, news couldn't be worse. I mean, it was great last year when the spreads were wide, but now the spreads are basically down to nothing. Very little compensation for some of the very real risks out there that we see. And these include credit risks. I mean, I think the economy is coming back little by little around the country, but there are tremendous sinkholes out there. There are tremendous areas that can open up and swallow investors whole. We call them blow-ups. But you're not being compensated for that on the credit front. Neither are you being compensated for any inflation risk. I don't think we're going to see a lot of inflation until we see more employment pick up around the country, until we see some real signs that there's some wage push inflation possible out there. But that risk is not compensated for with a 30 basis point spread. So, and particularly when you consider that the benchmark rate, the Treasury rate, the 10-year Treasury rate, is under 4%, one of the lowest rates we've seen in many, many years. It was lower a year ago under very extraordinary circumstances, but it's still very, very low and not really pricing in very much potential risk of inflation. So you're basically accepting a paltry yield and basically taking on quite a bit of risk when you do this. I think if you own bonds, if you own these bonds at prices, if you bought them, hopefully, at prices such as when we were recommending them a year ago, hold on to them by all means. Your returns are locked in. These companies aren't going anywhere, and in fact, the maturities are low enough to where there's not a whole lot of interest rate risk either. So you're golden if you own these things. If you own some of the open-end funds out there, you've already seen the yields come down. If yields should happen to go up with inflation or some other factor, those yields are going to go up as well. So you don't have a whole lot of risk for principal. The one area I'd be really careful about, or two things I'd be really careful about: one, buying new individual bonds, and two, some of these closed-end funds that some of you might hold. We've talked about some of them in Utility Forecaster. I think the ones that we've recommended are probably okay now, but you really want to be careful of some of these closed-end funds because the yields are still pretty high. They've been bid up, but those yields are going to come down as these managers have to refinance or replace these bonds that have been called or have matured out of their portfolio with lower yielding fare. They're either going to have to lever up by borrowing to increase the yield, or they're going to have to go further out on the risk spectrum. If they have an international or a junk bond focus, that means they're going to be taking some pretty outrageous risks. And that means you better keep an eye on what the funds you have hold. Now, what are the alternatives? Well, I think we give plenty of them in Utility Forecaster. You look at our MLPs, you look at some of our Canadian trusts, you look at our just bread and butter utilities like Duke Energy yielding almost 6%, Dominion Resources yielding over 5%, Southern Company yielding over 5%, even the big telecoms like Verizon, AT&T yielding almost close to 7% now. These are extraordinary yields. These are extraordinarily cheap stocks relative to where they've been in the past. Good time to lock them up. Certainly a lot better time to buy them than some bonds that are out there yielding 3-4%, and you're locked in forever. Stocks can increase dividend yields, another thing that bonds are simply not going to do. So those are my comments for today. We'll, of course, have more, another issue coming up shortly. But until then, you can keep up to date with the weekly utility and income. Many of these issues I've talked about regarding bonds and so forth are actually discussed in the most recent issue of Utility Forecaster Weekly. So with that, I'll sign off. Look forward to chatting with you next time.